Today, we're digging into something you probably don't think about when you hear AI, the hidden physical reality of the AI revolution. We're going way beyond the code and the fancy chips to uncover the real-world bottlenecks. The raw materials and the actual infrastructure that could really define this next wave of tech. We all tend to think of AI as this magical thing that just lives up in the cloud. But you know what? That cloud has a physical address, and it is built with tons of copper, concrete, and it plugs into immense power grids. This quote right here, it just nails it. It gets to the very heart of what we're talking about today, the tangible, industrial reality that's holding up this entire digital boom. For the last few years, the market has been absolutely laser-focused on companies like NVIDIA. And for good reason. They're the brains designing the AI chips. But as that part of the supply chain gets more established, new problems are popping up. The real bottleneck, and honestly, the overlooked opportunity, is in the physical stuff. The infrastructure needed to power, cool, and connect all that silicon. So, first up, let's just establish what we mean by AI's physical reality. We're going to connect the dots between this digital gold rush and the gritty, real world of power grids and digging stuff out of the ground. All right, Section 2, the trillion-dollar power grab. Now we're going to break down the absolutely staggering scale of what AI needs, starting with the mind-boggling amount of capital and raw power it takes to make it all work. Let's just start with the big top-line number. Global spending on AI is expected to rocket past $2.5 trillion in 2026. This isn't some niche little sector anymore. It's a massive, economy-shifting force that's sucking up an incredible amount of global capital. But here's where it gets really wild. McKinsey thinks we're going to need nearly $7 trillion in capital by 2030, just to build the data centers and physical infrastructure. Now, to put that into perspective for you, that number rivals the entire yearly capital expenditure of the United States across all industries. We are literally building a new global industrial backbone from scratch. But you know what? Money isn't even the biggest problem here. The real bottleneck is energy. By 2030, AI data centers are projected to demand 156 gigawatts of power. That demand is creating this mad scramble for electricity that our utilities and power grids are just struggling to keep up with. And if you want to understand just how insane this is, check this out. We're not talking about just needing a few extra power lines. A single company, OpenAI, is planning a project that will need the equivalent power of 26 nuclear reactors. This demand is so crushing that it's forcing companies like Microsoft to literally explore building their own nuclear power plants just to stay in the game. So here's the crucial point. The whole conversation has shifted. It's not just about who can make the fastest chip anymore. The new bottlenecks are things you can actually touch. Can we even get enough power? Can we build out the grid fast enough? Do we have the advanced packaging and the memory to put these things together? And maybe most importantly, can we even extract enough raw materials, like lithium, which, by the way, takes a staggering 500,000 gallons of water per ton to produce, to build all the batteries and components this new world demands? Okay, Section 3, playing the physical layer. You've heard the saying, right? In a gold rush, sell picks and shovels. Well, right here, we're going to explore how that exact same logic applies to investing in the AI revolution. So how do you actually invest in this physical layer? Well, there are really two main paths you can take. First is what we call physical exposure. This is where you buy stock in the actual companies doing the work. The miners, the utilities, the builders, you own a piece of the business. The second path is synthetic exposure. This is where you're using things like options or futures. You're not buying the company, you're just making a bet on where the price of the commodity or the stock is going to go. It's a lot more nimble. You can make money whether the market goes up, down, or sideways, but it's also more complex, and you don't actually own anything tangible. So what do these picks and shovels companies actually look like? Well, it's the entire supply chain. You've got your power infrastructure players, your utilities. Then you've got thermal management. The companies like Vertiv and Modine that are absolutely critical for cooling these super hot data centers. Then there's the networking hardware from folks like Arista, the physical builders like EMCOR, and then right at the bottom of the whole stack, you have the miners digging up the copper, lithium, and nickel that are the literal building blocks of this entire revolution. Now hold on, before we all rush out and dump our savings into mining stocks, we have to talk about the massive risk that trips up almost everyone who invests in this space. It's a really dangerous and frankly counterintuitive trap. I just love this quote from Charlie Munger. It perfectly captures the kind of healthy skepticism you need to have here. See,
Investing in basic materials isn't like investing in some software company. The economics are absolutely brutal, they're cyclical, and they are completely unforgiving.
This right here is the cyclical value trap. And here's how it gets you. When a commodity like copper hits an all-time high, the mining companies make record profits. Their earnings are huge, which makes their price-to-earnings ratio, their PE, look incredibly low. They seem cheap, like the bargain of a lifetime. But that is the moment of maximum danger, because those high prices encourage a flood of new supply, which eventually hits the market, causes the price to crash, and takes the company's stock right down with it. So that's the key question, isn't it? How do you get in on the upside of a real commodity boom that's driven by AI demand without getting totally wiped out when the cycle inevitably turns? Well, luckily, there are some tools we can use. All right, Section 5, Decoding the Cyclical Clock. Let's build ourselves a toolkit. I'm going to walk you through 2 really powerful ways to analyze these companies that'll help you look right past the hype and see the real value underneath. Okay, our first tool is the cost curve. The best way to think about this is like a map of who can produce a commodity at what cost. Every mine, every oil well, they all have a different cost to get the stuff out of the ground. If you understand this landscape, you can start to identify a potential floor price. That's the price where the high-cost producers start losing money and have to shut down. And when supply goes down, that helps put a floor under the price. And this is a perfect real-world example. In the oil market, it's pretty widely known that for a lot of fracking companies, their break-even point is somewhere around $50 a barrel. When the price dips below that, they just can't make money. So that $50 level acts as this really powerful economic and psychological support for the price of oil. If you know the cost curve for copper or lithium, it gives you that exact same analytical edge. Okay, our second tool is a super practical calculation called normalized earnings. This helps you just strip away the temporary hype from a price spike. It's pretty simple. First, you find the average price of whatever commodity you're looking at over a long time, like the last 10 years. Second, you take that average price and apply it to the company's current production to get a normalized revenue. From there, you can figure out a more realistic long-term profit number and a new normalized PE ratio. This shows you what the company might be worth in a normal market, not at the absolute peak of a speculative bubble. So let's bring this all home. The AI revolution, it feels limitless, right? Driven by pure human ingenuity. But what we've really seen today is that its pace might ultimately be controlled by something far more basic, the physical limits of our planet. So let's do a quick recap, our key takeaways. First, AI's growth is physically tied to power and raw materials. Second, the picks and shovel strategy is a smart way to think about investing in this build-out. Third, you have to watch out for that cyclical value trap, where a low PE ratio is actually a huge red flag. And finally, use tools like the cost curve and normalized earnings to make much smarter, long-term decisions. And that leaves us with one last big thought to chew on. For all the talk about exponential progress in the digital world, we might just find that the real speed limit on the AI revolution isn't the brilliance of our software, but the simple, brutal, and physical reality of how fast we can dig stuff out of the ground and build the world to power our future.